Hello everyone, and welcome to the new edition of A Chat with Daman Asset Management Team. The global markets witnessed another positive performance during this month. However, it was at a reduced pace. Led by emerging markets, MSCI All Country Index rose by 1.4%, and the Barclays Emerging Market Aggregate Total Return Index was up 0.9%. Due to inflationary pressures, we remain overweight on equities versus fixed income. In the equity space, we prefer value and cyclical sectors, in addition to the reopening themes. On the fixed income side, we remain underweight G10 rates and market weight on credit. Within credit, we are overweight high yield and market weight investment grade. I will start with Thomas. What are your views on emerging market debt?
Hello everyone. I would like to start by restating our view about our belief that emerging market debt are currently cheap relative to other asset classes and market segments. This market is, according to us, underowned, misunderstood, and usually associated with higher risk premia, which consequently translate into higher yielding debt on a risk-adjusted basis. We acknowledge that the market has changed recently and spreads have brought very little to date against the move of US Treasuries in an already tight investment grade spreads environment, while high yield provided better cushions. LATAM investment grade spreads, for example, have widened recently on political events in Chile, Mexico, and Peru, and the downgrade of Colombia, of course. We continue to think that the risk-reward for emerging market credit investors looks best in the high yield where valuation screens fair according to our model at the moment. Elsewhere, in Turkey, we think the country shall be focused on the management of its external liquidity issues, and we believe the front end should benefit from the lack of supply while the 10-year spreads remain high on the back of heavy positioning. In Asia, fiscal deficits development will be scrutinized in the second half of the year. Investment grade spreads have widened sharply in 2020 despite a certain consolidation in 2021, and consequently we're cautious on Philippines and Malaysia mainly on the back of that, while we see a better control of the fiscal deficit in Indonesia. Similarly to LATAM, we are selective on our high-yield picks and we see more value in names such as Sri Lanka, Papua New Guinea, Maldives and Laos, where spreads are trading extremely wide versus single B sovereign in the index, indicating that the market is factoring some sort of stress at the moment.
Tanya, how about your views on the MENA region, Sub-Saharan Africa and the Caribbean?
Thank you, Ali. In line with what my colleague Thomas just pointed out, we are acutely aware of the fact that investment grade spreads are extremely stretched, and hence we are overweight in the high yield space. In fact, we are tilted opportunistically towards the short end of the curve. Now, when we're investing in the high yield universe, we need to bear in fact that the principles of caveat emptor do apply, and we have to be very specific in terms of finding good stories and being very tactical. If we recap the last month in the high beta space, we were rewarded favorably for taking exposure to Tunisia, where we made 1.5%, in Cameroon, where we made close to 300 basis points, and Sri Lanka, which is up 11% month on month. In the same vein, we have taken additional exposure to Pakistan by partaking in the country's first green Eurobond, which is a quasi-sovereign 10-year bond of the Water and Power Development Authority. This again is a tactical investment to play the JP Morgan MB inclusion, which will come towards the end of June. In the MENA region, when we look closer, we continue to remain overweight in Egypt and Tunisia as we are continuing to play the IMF story, the aid which will be rolled out to Tunisia soon. If you look about, if you think about technical plays, we're looking at Jordan, we're looking at Iraq, but we remain cautious, yet acutely opportunistic in these stories as well. Now, coming back to Africa, as we highlighted in the last discussion, we remain very selective in the high yield space. But again, we are still playing the oil story. We remain overweight in Angola, and that's primarily due to certain catalysts. If we were to list them, one being the support of the China debt reprofiling that we have seen, the DSSI extension, the positive earlier IMF fourth review, the authorities most importantly not seeking the common debt framework, and coming to the last but most important point, the USD $1 billion new SDR allocation. It definitely helps that the AFF extension, which is going to expire, will be extended way beyond 2021. Now, if you look beyond the selective stories, we just look tactically and opportunistically in the short end of the curve, we like Cameroon and Gabon, which are very likely to benefit from the liability management. If you go far out to the Caribbean now, as we have mentioned since the start of these these discussions, we mentioned that we like Guatemala primarily because of how favorably they are placed with the emerging trend of nearshoring of global supply chains closer to the US, which is akin to having Vietnam and China, where when China grows, these are parallel supply chain economies, they do well. In the same way, Guatemala will do well. And we have seen US Vice President Kamala Harris basically talking about Microsoft and other companies making investments in Guatemala. In Bahamas, again, which is a country we like opportunistically, is they have received a $100 million COVID relief package, which would definitely help and assist them to fight the COVID battle and come back to recovery very soon.
Divier, what are your views on the equity space?
Thank you, Ali. Hello, everyone. We expect the global economic growth and long-term US Treasury yields to head higher and yield curve to steepen as vaccination rates continue to improve in developed markets, with emerging market catching up from fourth quarter 2021. As a result, in equities, we prefer an exposure to value stock in financials and energy sectors. We are selective on cyclicals, preferring materials post a strong rally in industrials and autos. On US, we are neutral given stretched valuations and low equity risk premium, especially on the tech side. However, we recommend value plays and reopening stocks on strong real GDP growth of about 7% in 2021. We keep our overweight exposure on the Europe due to much improved pace of vaccinations, our expectation of the region leading the global economic growth from third quarter 2021, and discounted valuation versus US. We maintain our neutral stance on emerging markets, and for us to be more constructive, we need to see a significant progress on vaccinations, inflation-linked volatility to play out, and US yields to head higher and stabilize, which could take place by third quarter. However, we do like an exposure to select EM markets. Exporters such as South Korea, Taiwan, and Mexico will benefit from a strong rebound in US growth. We like Saudi, UAE, and Qatar in the MENA region. In the region, given our constructive view on oil, increase in government spending and GRE spending, and gradual reopening of the economies, we continue to favor value and cyclical names in sectors such as banks, industrials, metals, and construction materials. Despite stretched valuation, Saudi market presents strong themes to play on, tied to Sharik program related spending and Vision 2030. Within the UAE, we continue to like reopening plays given the country's fast vaccine rollout and consolidation theme to increase efficiencies. In Egypt, we see certain names in sectors such as education, healthcare, F&B, and services as attractively priced for the strategic investors to come in.
Thank you for taking the time and watching another edition of A Chat with Daman Asset Management Team. You can always contact us on our website and social media platforms. Till the next edition.